This is Alex Gafford with Blue Shirt Capital. Welcome to this discussion titled Fuel Your Sales, 4 Simple Steps to Leveraging Financing. Wanted to just explain the purpose of the discussion for today. So to give you a little more detail, really want to give you detail into your customers' decision-making process, how they consider financing, how they formulate budgets. Today's mostly going to be high level financing discussion, but I am going to get into a level of details about financing that, trust me, you don't need to master or even know. It's more about peeling back a layer or two of your client's decision-making process, which will prove helpful as you navigate through transactions. So before we get started, I need you to understand a big concept that really your clients, each of your clients either finances or they don't. Okay. And most do, by the way. So according to the ELFA, which is the governing body for the leasing industry, over $1 trillion industry, 7 out of 10 businesses finance or lease their equipment purchases. So if you're not sure if your client finances, AKA you're not in discussions with the CFO, I can run a quick report that tells you unequivocally if they historically finance or lease their IT or equipment solutions. So I wanted to start off by just saying, let me help you at least identify who finances, which of your customers do finance. Okay, so the agenda for today will be about how to understand customer financial pain points, 2, bridge solutions with financing options. This is basically the antidote to their financial pain points. 3, engage financial decision makers effectively. Who makes the call on operating budget and financing? And then 4, offer payment options and how simple it is to simply offer a payment option and increase your sales. Okay, so step 1 is understand customer financial pain points. Okay, so there are a ton of reasons why your clients choose to finance, like a ridiculous number of reasons. Some are very complex and have to do with tax strategies and how they want to position their financial statements, or have to do with bank covenants and grants and all these different things. But I want to start with the 3 most common reasons why people finance. These are the 3 main pain points. Limited budgets. Okay. Companies have CapEx and operating budgets. Limited budgets. 2, long ROI timelines. And 3, cash flow constraints. So what do I mean by OpEx versus CapEx? Really simple example, a printer. A printer is CapEx. The ink and paper is OpEx. Okay. So when you have a customer that says, I don't have budget, they almost always mean CapEx. How do we get the discussion over to OpEx if CapEx is limited? Long ROI timelines. This is a huge point I'll get into more in a little while, but basically people want to shorten that ROI time as much as possible. They want to pay for what they're investing in as quickly as possible through revenue. And then 3rd, cash flow constraints. This is possibly the biggest reason. This is a major pain point because managers hate huge peaks in their financials, in their business. They don't want huge purchases messing up their flow. They want it to be fairly flat throughout the year and predictable. Financing helps achieve this. Okay, so what are some questions that you can ask to help identify these pain points? You can ask questions like, what budget challenges are you currently facing? Or do you have any cash flow constraints? Or you can simply just be curious and say, help me understand how your budget works and what issues you might have around securing budget for this purchase. It can be that simple. Okay, so step 2, you've identified the pain points and now you're positioning financing as a solution. Okay, so you're bridging these financial pain points with financial solutions. Some benefits of financing is like equipment leasing and financing. What we do, it's really quick, fast approvals, instant credit approvals in many cases, not a long drawn out process with a bank lender or equity lending. Of course, I had a deal a few weeks ago that within 4 days of being introduced to the customer, we were able to get a purchase order issued and processed. So the whole process from introduction to customer via email to purchase order being processed, 4 days. It was really quick. Financing hedges against inflation with predictable monthly payments. So general rule, as the environment like we're in right now, a more volatile inflation environment, financing becomes more common for this reason. Financing helps align costs with revenue generation. So especially people that are billing their clients. If you think of your customers that bill their customers monthly, their revenue rec is not great. But financing helps align with that and allows them to grow and scale. And then lastly, ROI. This is a huge concept. You're selling products oftentimes that have a return on investment for your customers. So you're selling a digital scoreboard. They're getting an ROI through the marketing dollars, right, that it generates. What's the period of time that pays for that scoreboard? Or you have a customer that signs a 3-year contract in this example with a customer worth $500,000. They're hosting that customer's data and they're providing services that they bill just under $14,000 a month. Okay. Do they get to recognize that $500,000 when they sign that 3-year contract? They don't get to recognize that then. They only get to recognize not even 1/3 of that for the year. They only get to recognize what they bill that month. So revenue recognition is not that great. And let's say they have to buy $200,000 of IT infrastructure from you. How long is that going to take for them to get their ROI? It's going to take about 14 months. Okay. So they want to shorten that period as much as possible. Most businesses, they want to get their ROI within a couple months, not a couple years. Okay. So 14 months, they might say, look, this has got to be under a year at least. So you're going to need to lower your price. What's another thing they can do? Maybe go with a cheaper solution. So they're going to get suboptimal results. They're not necessarily buying what they truly need, but then they start to come up with different lower quality options. So it could be a combination of everything. You're going to get lower volume, lower quality product, and less margin on this deal. And the customer's not going to be as happy. So if they finance the deal, it completely changes this. So they get instant ROI. So the financing in this example, $500,000 is $6,300 a month. Okay, so they get $7,500 revenue month one, instant ROI. This is a huge, huge concept. Now, I want to talk about how financing helps grow deal size and margin, because what this ends up being is a win-win-win. So it's not just a win for you. This is a win for the customer, because you're enabling your client to buy what they actually need versus what they perceive they can afford, because they've got this capital budget, right, that is limiting how much they can buy. So what I'm proposing is that you offer your clients financing so they can buy what they really need. It's going to help you preserve margin, so you're not going to get beat up on the cost. And then it also focuses on long-term growth. So this is a win for the business, because you're now going to the management team and we're establishing a credit file of maybe a couple $1 million, if that's what they're going to be spending over the next year, 2, maybe 5 years in IT, for instance. We'll go ahead and get that approval. And every subsequent schedule is a 1-page schedule added to their master agreement via DocuSign. It's easy. So we're making it easy for them. We're allowing them to buy what they need and allowing them to grow and scale their business more easily. Another great real world example is vendors. You may offer some type of 5-year warranty or 5-year support package, but most default to 1 year. So we have one of our top partners that we do over $1.5 million in volume with, average about $150,000 per deal. Their deal size increases by 20% when they offer 5-year maintenance, and it more than doubles their margin. And most of their customers, when they do a 5-year lease, opt for the 5-year support package. So it's a win for the customer because they get coverage during the full period of time. It's a win for you, better volume, better margin. Okay, so let's move on to step 3, which is engaging financial decision makers. Okay, so it's almost like a different language. speak this financial language. I'm on the phone with CFOs every day, talking about their budgets, talking about how they want the financing structured to make a large purchase. I love this diagram. It kind of illustrates what the CFO or the head of the finance department sees. It's like this large blue bubble. You can think about it. They just see this huge view of the company, whereas maybe in the yellow, it might be an IT director. They only see the IT department. They don't see how the budgets are formulated. They don't know how their purchases impact the company from a financial perspective. So it really helps build credibility when we're talking at the highest level possible on finance. If you're having trouble identifying who that is, you can ask questions like, who makes the call on your budgets? Or when it goes operating budget or needs to be financed, who's your point of contact? If you still are having trouble, you can bring me on the call and I can help you navigate this kind of financial decision-making process. Okay, step 4 is offer payment options. So the last step is pretty simple. When you offer payment options, you increase your sales. If anybody on this call is in the tech department or tech industry, they've probably seen Dell quotes for enterprise solutions. What's on every Dell quote? At the bottom of the quote, every Dell quote has a payment option. It usually says something like payments as low as this per month, with a little verbiage, pending final credit approval, yada, yada. So the point is just by offering payment options, putting it on your quotes. Some people have even buttons that they can click through. Some of our formal partners have buttons that we've helped them put on their quotes and invoices. When they click on it, they get either instantly approved or not, and for a certain amount of money. So it just makes it super easy. So instead of them looking at, oh, this is a $350,000 purchase, they can look at that option down at the bottom. Oh, it's $7,300 a month. I think I can go with that. And so it moves it over to operating budget and it allows them to buy, remember, what they need versus what they think they can afford. So cool. Okay, so just to summarize how financing is useful for driving sales growth, just want to recap. We talked first about financial pain points. We talked about bridging solutions with tailored financing. We talked about engaging decision makers to have ROI and cash flow discussions. And then we talked about offering payment options. Something as simple as that increases your sales. Okay. And at the end of the day, if you think about it, it's not a crazy concept. Businesses, this is how businesses operate. They finance their purchases. Think about it from a consumer perspective. Think about how crazy it would be if you were introduced to a real estate agent and they're like, I can only work with cash customers, only cash. We only sell property with cash. Or if you went to a car dealership to buy a new vehicle and they're like, yeah, we sell brand new vehicles, but we don't accept cash. We only accept cash customers. Like that would be crazy. So it's the same way with business, but probably even more prevalent. Again, 7 out of 10 businesses utilize financing to acquire equipment and technology solutions. So I want to end on this idea that we are an extension of your sales team. Our most formal partners would even refer to us as a pre-sales finance specialist. So if you're in the IT industry, you probably have a pre-sales engineer, a technician, or of some sort. Everyone has some expert product specialist that they can bring on the call to help increase their sales. We are that for financing. So leverage us. Let us know who your customers are so we can pull reports and tell you, pull public record. They're not going to get credit inquiry. We're simply giving you data to see so you can determine which of your customers finance and which ones don't. And just remember, the ones that do historically finance, it's way easier in most cases for them to finance the product than to ever get capital budget approval. And now I'm going to open it up for questions.